March 2021. A single family office's margin calls set off a chain reaction that stunned Wall Street, exposed a blind spot in market transparency, and left some of the world's largest banks holding the bill. At the heart of the story is a deceptively simple derivative, the total return swap. On paper, it looks harmless. One party pays financing, the other delivers the total return of a stock. Price changes plus dividends, without either side trading the underlying shares. In practice, this instrument allowed a private firm to build concentrated exposures to a handful of public companies, while staying largely out of public view. What was at stake was not just the fate of one leveraged portfolio, but the credibility of risk controls at global prime brokers and the adequacy of U.S. disclosure rules around security-based swaps. When the tide receded, it revealed a system optimized for speed and revenue, not for resilience. The cast of characters includes Archegos Capital Management, a New York-based family office run by Sung Kook Bill Hwang, a close inner circle overseeing trading, finance, and risk, and a slate of prime brokers eager to extend leverage through swap financing. On the regulatory side sit the Securities and Exchange Commission, the Department of Justice, and the Commodity Futures Trading Commission, each with a different mandate, but a common concern about market integrity. In the background are the issuers whose shares were lifted on the way up and pummeled on the way down, and the investors, large and small, who became involuntary passengers on a roller coaster powered by opaque leverage. The timeline begins with a rebuild. After prior regulatory penalties unrelated to this episode, Hwang re-emerged running a family office, meaning no outside investors, and began amassing positions through total return swaps with multiple banks. Through 2019 and 2020, those positions grew. Into early 2021, exposures became heavily concentrated in a short list of media, technology, and Chinese internet stocks. Because the firm commonly used cash-settled swaps rather than owning shares directly, it avoided public position reports that would have been triggered by conventional ownership thresholds. March 2021 was the breaking point. A negative catalyst in one core holding led to margin calls. When Archegos failed to meet them, counterparties rushed to liquidate. The first movers escaped with modest damage. Those who hesitated took heavy losses. The unwind was fast, disorderly, and drew the attention of civil and criminal authorities through 2021, 2022, and 2023. Mechanically, the episode, as alleged by regulators, exploited three levers at once: size, silence, and signaling. Size came from stacking swaps across many prime brokers. Each bank saw its own slice, but not the whole, which let aggregate exposure balloon far beyond what any single risk desk would likely have approved if it had known the full picture. Silence came from the structure of derivatives regulation in the United States. Security-based swaps tied to single-name equities were not subject to a 13F-style public filing regime during the period, so the market never saw the true footprint. Signaling came from trading behavior. As alleged, the firm and its traders repeatedly bought in ways that supported prices of key positions, then used those buoyant marks to secure still more financing. Because swaps are margined to the daily mark, rising prices loosened the constraint, encouraging more leverage in a classic positive feedback loop. The result was synthetic ownership without ownership. The economic effect of a swap that references a company's stock is similar to holding the stock itself, but without voting rights or public disclosure. Banks that wrote those swaps hedged their exposure by buying the underlying shares, so the buying pressure showed up in the tape as if many independent investors were bullish. In reality, they were hedges of the same client's derivative book, spread across multiple dealers. This circularity meant that price strength made the portfolio look safer to risk systems that were keying off recent volatility and liquidity, even as concentration risk intensified. When a single issuer sold off sharply, the collateral calculus flipped. Margin calls landed. Some banks tightened terms immediately. Others negotiated and waited. In a rush for the exits, minutes were the difference between a briskly executed block trade and a disorderly avalanche. Incentives amplified the vulnerability. For prime brokers, the swap business is attractive. It throws off financing income, trading spreads, and a halo of cross-selling. The internal scorecards, revenues from financing, client wallet share, return on risk-weighted assets, reward scale. Relationship managers chase mandates. Risk managers, in theory, rein them in. But when business is concentrated with a star client and the market seems benign, discipline can soften. Margin rate disputes creep in, house limits get temporarily lifted, and uncomfortable stress scenarios are waived with reassurances about liquidity. On the client side, swaps turned $1 of equity into multiple dollars of exposure. The bargain was seductive. Keep paying the financing charge, keep margins topped up, and the upside from concentrated bets accrues with minimal dilution. Controls failed at multiple choke points. At onboarding, several banks accepted representations about liquidity, diversification, and hedging capacity that events later contradicted. Ongoing monitoring leaned heavily on measures like value at risk and short look-back stress tests that underweighted gap risk in concentrated names. Escalation protocols. What to do when a client asks for lower margins or when positions breach soft limits were inconsistently applied. For one major counterparty, a special committee later concluded that repeated internal warnings about counterparty credit risk had not led to decisive action. Across the street, documentation proved weaker than assumed, with insufficient rights to demand intraday margin or to liquidate rapidly without negotiation. Meanwhile, because exposures were spread across dealers, no single risk team saw that what looked like a manageable bilateral relationship was, in aggregate, an ecosystem-level concentration. Regulatory actions through 2022 and 2023 reframed the episode from private misjudgments to alleged fraud. Civil complaints by the securities regulator alleged that the firm and specific individuals engaged in a scheme to mislead counterparties about the size and liquidity of positions, to conceal the true degree of concentration, and to manipulate market prices through persistent, aggressive buying in favored names. Prosecutors in New York unsealed an indictment alleging racketeering conspiracy, securities fraud, and wire fraud, asserting that the defendants lied to banks to obtain credit and engaged in a pattern of conduct designed to maintain inflated marks. The derivatives regulator filed its own action focused on swaps, alleging deceptive devices and reporting failures tied to the security-based swap book. Each agency's filing differed in emphasis, but the core narrative overlapped: the use of opaque derivatives to build hidden exposure, the provision of misleading information to counterparties, and trading that allegedly distorted prices. Importantly, enforcement did not stop at the client. Supervisors held banks to account for risk management weaknesses exposed by the collapse. A central bank authority announced a consent order in 2023 that required one prime broker's new parent to remediate counterparty credit risk practices in its U.S. operations and levied a significant civil money penalty. The supervisory language was blunt. Repeated warnings had not translated into effective action, and long-standing deficiencies had to be addressed. Other jurisdictions scrutinized affiliates abroad, but within the U.S. remit, the message was consistent. Prime brokerage is core to market plumbing, and its controls must be fit for purpose when clients employ complex derivatives at scale. For victims and market fallout, the pain radiated outward. Prime brokers absorbed multi-billion-dollar hits, with one institution reporting losses of roughly $5.5 billion tied to the default. Those losses dented capital, triggered management changes, and forced hard looks at client books across the industry. In the equity market, the unwind crushed the prices of favored stocks, vaporizing tens of billions in market capitalization in days and punishing passive shareholders who never heard of the family office until after the collapse. Issuers saw financing plans disrupted. Liquidity thinned temporarily as dealers digested block trades. For regulators, the episode became Exhibit A in the case for swap position transparency and stronger dealer controls around concentrated counterparties. Lessons for viewers, and for anyone running diligence on complex counterparties, start with transparency gaps. If economic exposure can be built synthetically without tripping public disclosure, assume that what you cannot see may still move the market. Read risk reports with a skeptic's eye. Value at risk is not concentration risk, and backtests do not forecast catalyzed gap moves. For financial institutions, insist on multi-dealer visibility when exposures become material. If clients resist, that is itself a signal. Do not negotiate margin from the rearview mirror of recent calm. Stress names, not just portfolios, using forward-looking liquidity shocks and issuer-specific catalysts. Hardwire escalation so that commercial teams cannot quietly stretch beyond house limits. For investors, be wary of seemingly inexplicable rallies untethered from fundamentals. Persistent, aggressive end-of-day bid support can be a red flag when it clusters in a handful of names, without parallel moves in peers or indices. And for policymakers, the episode underscores that disclosure regimes built around cash equities can be outflanked by derivatives that replicate the same economics with thinner transparency. One subtle signal worth highlighting is how dependence on multiple prime brokers can mask fragility rather than reduce it. Diversification sounds prudent, but it only works if the dealers share risk intelligence in some form, or if the client's total leverage is constrained. When they do not, each dealer rationalizes incremental exposure by assuming the others are doing the same monitoring. That is how synthetic ownership of large slices of float accumulates without anyone owning up to the aggregate. A related signal is the eagerness of dealers to reduce margins or waive limits for strategic clients in competitive situations. The price of winning the relationship can be a quiet erosion of guardrails that only becomes visible when the market turns. In the end, this was a hidden leverage trap, sprung by a collision of incentives and opacity. The client's incentive was to maximize exposure in a tight circle of convictions. The dealer's incentive was to grow financing revenue and share of wallet. The market's vulnerability was a disclosure framework that did not surface synthetic ownership in time for price discovery to adjust. The liquidity that seemed plentiful on the way up evaporated on the way down. And when it did, the mismatch between economic exposure and legal ownership made the unwind more violent. The lesson is not that swaps are inherently malign, they are tools, but that concentrated bets with borrowed money require controls tailored to their actual risk, not their accounting form. If you found this unpacking useful, share it with someone who cares about how modern market plumbing really works, and subscribe for future deep dives that decode the mechanics behind the headlines without the hype.